Welcome to the Deep Dive. Today we are focusing all our attention on Opendoor Technologies, ticker Open. The company that really pioneered that whole iBuying thing, instant home buying.
Yeah, it's a really fascinating story, actually. Opendoor came out promising to completely shake up real estate, but then the market turned. And that model, well, it was basically high-stakes house flipping, super capital intensive. It ran into trouble fast.
Big trouble. And that failure forced this pretty drastic strategic pivot we're seeing now. So the big question today is, can Opendoor actually pull this off? Can they transform from, a risky property owner into a high-margin, capital-light, AI-first tech platform?
And it's not just a pivot, right? It feels more like an existential crisis, a complete corporate makeover. And the market's reaction, that's what makes this deep dive so timely. There's this massive disconnect happening right now. The stock's just soaring purely on narrative, it seems, trading currently at $8.19 a share.
But the fundamentals,
Yeah.
they seem to tell a very different story.
Exactly. Our analysis, even if we assume they perfectly execute this ambitious new strategy, well, our risk-adjusted valuation model suggests the intrinsic value is only somewhere between, say, $3.50 and $7.50 per share.
Wow, that's a huge gap.
It is. It's an extremely high-risk, high-reward situation. The market's basically pricing in a flawless turnaround right now.
Okay, so we're going to walk you through this whole high-stakes bet. We'll dig into the new business plan, take a hard look at the aggressive new leadership team, dissect those pretty shaky financials they inherited, and then unpack the market sentiment. What's driving that $8.19 price tag? All right, Chapter 1, Business Understanding. Let's start with the basics. What Opendoor used to be versus what it's trying to become now. Historically, they were the definition of an iBuyer, weren't they?
Totally. Made all cash offers using their algorithms, bought the houses, did some light fix-ups, and then tried to resell them quickly. But that model needed enormous amounts of cash, and it really only works smoothly in a perfect housing market.
Which we definitely don't have now.
Exactly. That dependence on capital, that was the anchor when interest rates went up. So the new strategy, the one really taking shape in late 2025, it's a very deliberate shift away from primarily owning homes. They're moving towards this diversified, platform-focused model. They call it AI first and agent-led.
Okay, AI first. We hear that buzzword everywhere. Honestly, it often sounds like just market jargon, right? Get you to pump up a turnaround story. Why should we believe Opendoor's AI is any better or more defensible than, say, Zillow's? Zillow failed spectacularly trying this.
That's the million-dollar question, isn't it? And the answer really comes down to scale and time. Opendoor has what looks like a genuinely proprietary data moat. They've done over 250,000 transactions. That's a lot of data points. But more than that, they've gathered millions of internal photos, videos, and really granular real-world data on actual repair cost. Like the nitty-gritty cost of fixing a leaky faucet in Phoenix versus Dallas. It's that unstructured data that fuels their proprietary AI and pricing algorithms like the one they call Risk AI.
So the data isn't just about setting the initial offer price. It's about managing the risk of actually holding the house.
Precisely. Zillow's failure proved it. If you can't accurately price the house and predict the renovation costs down to the dollar, you're going to lose money. Opendoor is betting that their deep, specific cost data gives them the tech edge they need to manage that risk better than anyone else could.
And this data is presumably underpinning their new, supposedly capital-light product, Cash Plus. That launched back in July 2025. Can you break down that hybrid model for us?
Yeah, Cash Plus is pretty clever from a risk management standpoint. Opendoor still gives the seller a guaranteed cash offer up front, so the seller gets that certainty they want. But here's the twist. Instead of Opendoor buying it right away, the house gets listed by a local agent on the open market.
So Opendoor doesn't have to carry it on their books immediately.
Exactly. It dramatically reduces Opendoor's balance sheet risk. They aren't obligated to hold all that property inventory themselves.
And now they're trying to cozy up to agents. Weren't agents supposed to be their competitors?
They absolutely were. But the pivot changes everything. They've launched things like the Key Agent app. The whole idea is to turn agents into partners, feed them seller leads through something called Key Connections. Opendoor wants to be the platform facilitating transactions for a fee, rather than taking on all the inventory risk itself.
Okay, Chapter 2, Management Evaluation. Now let's get into the drama. The founders' coup that really grabbed headlines in late summer 2025, right after the previous CEO stepped down. This was a pretty radical leadership shakeup.
It felt necessary, didn't it? Signaled extreme urgency. They clearly needed someone who could execute maybe ruthlessly. So they brought in Kuz Najation, the former COO from Shopify. He's known as an AI native executive, supposedly a specialist in driving massive operational efficiency.
And maybe even more significant for the culture change, you had the return of Keith Rabois as chairman. Co-founder, PayPal mafia guy, Rabois has a reputation for super aggressive execution, tight cost control. He's even said publicly he thinks the company is bloated.
Yeah, his return sends a clear message. No more business as usual. And we also saw the other co-founder, Eric Wu, come back to the board. This whole new lineup feels like a power move.
And they backed it up with cash, right?
They did. They announced a new $200 million share repurchase program in August 2025. That's management putting skin in the game, signaling they believe the stock is undervalued.
Okay, so you have this powerhouse team coming in. Let's talk about the financial mess they inherited. What's the core economic problem Najation and Rabois absolutely have to fix, like yesterday?
The core problem, value destruction. Plain and simple. You have to look at the return on invested capital, ROIC. Basically, this tells you how much profit the company earns for every dollar it invests in its operations. Opendoor's historical ROIC, well, it's been consistently deeply negative. Recently in the TTM range, it was like -4% to -8.5%.
So wait, for every dollar they poured into buying and flipping a house, they were actually getting back less than a dollar.
Yeah. Yes. They were actively destroying shareholder value with every transaction, essentially. The entire shift to a capital-light model is a direct, almost desperate attempt to escape that broken economic engine and finally, hopefully, generate a positive ROIC.
And thinking about that old model, the speed, the aggression, there were compliance issues too, weren't there?
There were big ones. They had that $62 million FTC settlement back in 2022. The accusations were about misleading marketing, specifically bait and switch tactics, giving a high initial offer online, then drastically cutting it after the in-home check.
62 million is not small change.
Not at all. It really underscores the legal risks baked into these high-speed, high-volume transactional models.
All right, Chapter 3, Financial Analysis. Let's dive into the numbers. Opendoor's market cap is sitting around $6.5 billion. But looking back, the financials show a business that's just incredibly sensitive to the wider economy.
Oh, absolutely. Look at the revenue volatility. It's wild. Went from, $2.58 billion in 2020, then shot up to $15.5 billion in 2022 during that pandemic housing frenzy.
Yeah, crazy times.
Only to crater back down to $5.1 billion in 2024 when interest rates spiked. The top line is completely at the mercy of the housing cycle. There's just no way around it.
And what about actually making money? Profitability.
Well, that's the kicker. The company has never reported a full-year net profit, ever. Margins are razor thin. Gross margin is about 8% TTM. But after you factor in all the operating costs, the net margin is negative 5.89% TTM.
So they're losing almost 6 cents for every dollar of revenue.
Consistently, the old business model, fundamentally, just didn't generate profit.
Okay, but here's the paradox then. They report a really strong current ratio, like 4.35. That usually suggests good liquidity, low near-term risk. How could a company that's never made a profit look so liquid on paper?
Right. That's the liquidity paradox, and it's super important to understand. That positive cash flow, they showed $544 million in the first half of 2025. That was not a sign of profitability. Not at all. It was a sign of liquidation.
Okay, explain that. Like, what does that mean in simple terms?
Think of it like this. Imagine you own a shop that's losing money, and you need to pay rent. If you start selling off all your store fixtures, your inventory, faster than you buy new stuff, you'll suddenly see cash pile up in your bank account for that month.
Ah, okay. So you have cash, but your business isn't actually fixed.
Exactly. You haven't fixed the underlying problem. You're just converting your assets into cash. Opendoor was aggressively selling off its housing inventory much faster than it was buying new homes. They were turning houses' assets into cash.
So it looks like smart balance sheet management in a tough spot. But it doesn't solve the fundamental issue of how to actually make money. It just highlights why they needed this strategic pivot so badly.
Okay, Chapter 4, Market Sentiment. This brings us to that massive disconnect we mentioned earlier. You've got the professional analysts on one side, and then this market hype machine pushing the stock up to $8.19.
Yeah, the contrast is stark. The analyst view is overwhelmingly negative. The consensus rating is basically reduced sell, and their average 12-month price target is shockingly low, somewhere between $1.10 and $1.45. Wait, $1.10 to $1.45? Compared to over $8 now? That's implying, what, over 80% potential downside?
Exactly. That's what the professional analysts, looking at the fundamentals, are projecting.
So why on earth is the stock trading so much higher? What's driving it?
Narrative. Pure narrative. The stock's often talked about as a meme stock. It's driven by the drama around the management change, this really compelling AI-first turnaround story.
Yeah.
And technically, the momentum is strong. It's trading well above its 50-day and 200-day moving averages. The market isn't betting on history. It's betting entirely on the future execution.
And you mentioned high short interest earlier. That adds another layer of volatility, right?
Huge layer. The short interest is massive. Somewhere between 23% and 27% of the available shares are shorted. That confirms the bearish sentiment from many, but it also creates the perfect setup for a potential short squeeze.
Meaning if good news hits, the shorts have to buy back shares quickly, pushing the price even higher.
Precisely. And what really added fuel to the bull narrative recently was the disclosure that Jane Street Group took a 5.9% stake. Jane Street is a very well-respected quantitative trading firm, so many saw that as serious institutional validation for the turnaround story.
Okay, Chapter 5. Ownership structure. That Jane Street news brings up the question of conviction. Who actually believes in this? We see quant funds like Jane Street buying in. What about the insiders, the people who know the company best?
Well, that's where the bull case gets some support. Insider transactions have been overwhelmingly positive, actually.
Really? Like who?
The key one to note is co-founder and new board member Eric Wu. He bought 451,127 shares himself on the open market back in September 2025, paid about $6.65 per share. That's a significant chunk of personal cash invested directly. Insiders usually only do that kind of open market buying if they're very confident the price is going up.
Okay. That is a strong signal. Or is it maybe just a co-founder trying to prop up the narrative? Make a big buy to stabilize the stock, maybe attract other investors before a potential future share offering.
That's the healthy skepticism you absolutely have to apply. And the broader ownership structure kind of reflects that split thinking. You see the traditional long-term asset managers, Vanguard, BlackRock, they've been trimming their positions, likely looking backward at the terrible historical performance.
While the opportunistic funds are jumping in.
Exactly. Funds like Jane Street, Queb,
Yeah.
the more quantitative, forward-looking funds, they're buying into the turnaround story, the potential. So the ownership really shows this divide. Half the market sees a failed iBuyer, the other half sees a potential future AI powerhouse. It's pure speculation driving the price right now.
All right, Chapter 6. Risk assessment. Let's try and pull together the biggest dangers here. Starting internally within Opendoor itself, what's the single biggest hurdle for this turnaround plan?
I'd say it's the extreme execution risk. I mean, they are fundamentally shifting their entire business model towards something unproven. This agent-led platform concept, that's a monumental task. It needs flawless tech execution, a massive cultural shift.
And they have to do it while managing existing problems.
Right. Layered on top of a significant debt load and that ever-present inventory risk, the basic danger of owning physical houses in a volatile market.
Okay, and externally. Opendoor obviously can't control the housing market itself. Interest rates must be the big one.
Definitely the primary external threat. Interest rates act like a double whammy for them. Higher rates increase Opendoor's own borrowing costs for inventory, squeezing their capital.
And they hurt demand.
And they simultaneously suppress buyer demand by making mortgages way more expensive for everyday people. Opendoor's fate is just fundamentally tied to the health of the housing market. Rate hikes hit them hard from both sides.
And we found something else, didn't we? A specific, maybe unexpected geopolitical risk that hits their margins directly.
Yeah, that's the impact of those 2025 tariffs. You've got tariffs of, 25% on steel and aluminum and about 14.5% on Canadian lumber. These directly increase the cost of construction materials.
And since Opendoor does renovations, even light ones, on pretty much every house,
it acts like a direct tax on nearly every single transaction. It squeezes their already razor-thin gross margins even further. It basically guarantees their AI pricing has to be incredibly accurate, or they'll lose money just on repairs. It adds this significant, unexpected friction right when they're trying to execute this massive turnaround.
Okay, Chapter 7, Conclusion. Let's try to synthesize these two competing narratives. First, let's lay out the bull case again, the best possible outcome here.
Sure. The bull case really hinges on this elite new leadership team, Najation, Rabois. They have the mandate and presumably the skill for radical change. They're pushing this smart-sounding pivot to a capital-light model, which is theoretically protected by that unique data moat they've built. Add in the strong insider buying. Well, the narrative paints a picture of a huge future opportunity if they get it right.
Okay, now the bear case. Why should a skeptical investor just stay away completely?
The bear case is simple. Look at the history. A consistent track record of huge losses, significant financial leverage, extreme uncertainty about whether this new model will even work. And on top of all that, this heavy dependence on a stable housing market, which is anything but guaranteed.
So factoring in all that risk, where does our valuation land again?
Well, given the enormous risk here, we used a pretty high discount rate in our model, 15% to 20%. And that gives us an estimated intrinsic value range of $3.50 to $7.50 per share.
And the market price is $8.19.
Exactly. It's trading above even the high end of our risk-adjusted value estimate, which means the market is pricing in essentially near-perfect execution of this turnaround. An investment right now isn't really based on fundamentals. It's a highly speculative bet that the narrative plays out perfectly. There's very little margin for error if anything goes wrong.
So here's a final thought for you to consider. If Opendoor does somehow manage to monetize this AI platform successfully, is the ultimate end game maybe not even about flipping houses anymore? Could they become something like the AWS, the Amazon Web Services, but for residential real estate? Selling their pricing tech and data insights to the entire industry, even traditional brokers. That's the really big blue sky idea to think about.
Definitely something to ponder. We hope this deep dive was valuable for you, helped you maybe separate some of that narrative hype from the underlying business value.
And hey, remember to like and subscribe to Stock Analytics AI. Our members pay just $4.99 a month, and they get priority deep dives on all the S&P 500 stocks. We're covering them all. If you just want a one-off deep dive like this one on a specific stock, you can drop us a super thanks.
And please remember our crucial disclaimer. This research was generated by an AI system purely for educational purposes. It is absolutely not financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.